If there's one truth in trading that never changes, it's this. You can have the best strategy in the world, but without proper capital management, you're just walking toward the edge of a cliff with your eyes closed. I learned that the hard way. And if you've been in the markets for any length of time, you've probably felt it too. That sting of watching your account bleed out, not because your analysis was wrong, but because your money management was non-existent. Let me take you back to the first year I seriously tried to make trading my career. I had the enthusiasm, the late nights, the screen time. I thought my edge was sharp enough to slice through any market condition. But what I didn't realize is that the market doesn't care about your enthusiasm. It cares about your risk. I was over-leveraged. Every trade was a gamble disguised as a calculated move. I convinced myself that using big position sizes would speed up my success. I thought, why wait months to double my account when I can just do it in a week? Well, I got my answer. I doubled my account in 5 days. And then I blew it all in one afternoon. Mistake number 1. Over-risking per trade. I can't stress this enough. If you risk 10%, 20%, or God forbid 50% of your account on a single position, you're not trading. You're gambling in slow motion. It's seductive though. The math of greed is very persuasive. You look at a setup and think, if I just risk big on this one, I can make next month's profit in a day. And sure, sometimes it works. That's the trap. That one win convinces you it's a viable plan. But markets aren't built to reward recklessness forever. One bad trade, and you're done. Not just financially, emotionally. Capital management is about staying in the game long enough to win, not about winning instantly. Mistake number 2, not defining a maximum daily or weekly loss. In my early days, I treated every trading day like a battlefield. If I lost in the morning, I'd fight harder in the afternoon to get it back. And if that didn't work, I'd push into the evening, searching for setups in markets I didn't even normally trade. It was like a boxer staying in the ring after he's already knocked out, swinging at shadows, hoping to hit something. I had no stop point, no line in the sand. And because of that, I would take one bad day and turn it into a catastrophic week. Sometimes a catastrophic month. I learned, you must protect your capital from yourself. Because when you're emotional, you're the most dangerous opponent you'll ever face. Mistake number 3, not scaling risk with account growth. This one's sneaky. Imagine you start with $1,000 and risk $50 per trade. That's 5% risk. High, but manageable in your mind. Then your account grows to $3,000, but you're still risking $50. Suddenly, that's less than 2% risk. It feels too small now. So what do? You adjust by risking $150 per trade. Now you're back at 5%. But here's the twist. You're risking more absolute dollars, which means your losses sting harder. And if your account grows to $10,000 and you keep that same percentage risk, the dollar amount feels massive. That emotional pressure makes you interfere with trades, closing them too early, moving stops, hesitating to enter good setups. Capital management isn't just numbers. It's about matching risk to both your account size and your emotional tolerance. Mistake number 4, ignoring compounding in reverse. Everyone loves to talk about compounding gains, but no one talks about compounding losses. If you lose 50% of your account, you don't need a 50% gain to get back to break even. You need 100%. That's the dark math of trading. I remember one month where I lost 30% of my account in just 3 trades. I thought, no problem, I'll just win it back. But here's the reality. When you're down, every win gives you a smaller percentage of recovery than you think. And the pressure to catch up leads to worse decisions, which cause more losses, well, you get the picture. Good capital management is about making sure you never dig a hole so deep you can't climb out without superhuman performance. Mistake number 5. Trading too many correlated positions. This one is subtle. You might think you're diversifying, taking trades in gold, oil, and the S&P 500 all at once. But if they're all moving based on the same macro event, you're not diversified. You're just multiplying your risk exposure. I learned this during a volatile week when the US dollar went wild. I had trades in EUR, USD, GBP, USD, and AUD, USD. 3 different pairs, 3 different setups. But the same currency on one side, the US dollar. When it spiked unexpectedly, all 3 trades collapsed at the same time. It felt like 3 losses, but really, it was just one giant risk that I'd split into 3 identical mistakes. Mistake number 6. No plan for withdrawals. You know what no one tells you? If you don't plan how to take profits out of your trading account, the market will eventually take them for you. I used to think, I'll just keep compounding until I'm rich. And sure, in theory, that works. But in reality, life happens. Bills happen. Emergencies happen. And when you mix withdrawals with poor capital management, you end up in a death spiral, pulling money out right after a losing streak, leaving your account crippled and unable to recover. A real trader treats withdrawals like any other risk management tool. Structured, scheduled, intentional. Mistake number 7. Forgetting that capital management is psychological first. Here's the truth. Money management isn't just about numbers on a spreadsheet. It's about protecting your mind. If you risk too much, you'll make bad decisions out of fear. If you risk too little, you'll sabotage yourself out of frustration. The sweet spot is different for everyone, but finding it is the real work. I've met traders who never blow up an account, but slowly bleed out because they risk so little that the gains don't keep up with their costs. And I've met others who risk so much that every trade feels like their financial future is hanging in the balance. Both are wrong. Capital management is about creating a mental space where you can trade objectively without desperation or overconfidence clouding your judgment. When I look back at my own journey, I realize that capital management was never the boring part of trading. It was the essential part. It was the invisible shield between me and the market's ability to take everything I had. Every blown account I've ever had wasn't because my strategy stopped working overnight. It was because I either ignored risk or I convinced myself that I could bend the rules this time. I've learned to respect the math, to understand that my job isn't to make money as fast as possible. It's to survive. Because in this game, the survivors are the ones who eventually thrive. And maybe that's the part most traders don't want to hear. We all love the idea of big wins, fast profits, financial freedom in a year. But the truth? If you manage your capital well, you'll probably grow slower than you want. And that's okay, because slow growth is still growth. And more importantly, it's sustainable. The market rewards those who can stay in the arena the longest. And capital management is your ticket to staying there. So if you remember nothing else from my story, remember this. You don't have to be the smartest trader. You don't have to be the most accurate trader. But you must be the trader who manages capital like it's sacred. Because in the end, it is